What if the internet, as we know it, had taken a drastically different turn? Imagine a world without Google. A digital landscape fragmented, search queries lost in a sea of irrelevant information. For a brief, terrifying period, this alternate reality was not just a possibility, but a looming threat. The titan we know, the company that organizes the world's information, very nearly vanished before it ever truly began. Its story isn't one of inevitable triumph, but of near catastrophe, forged in the crucible of early ambition and profound risk. The internet, hanging by a thread. In the mid-1990s, the digital revolution was still in its infancy. Two Stanford PhD students, Sergey Brin and Larry Page, shared a vision. Not just for a better search engine, but for an entirely new way to understand the interconnectedness of information. Their initial project, dubbed Backrub, was a research experiment. A simple concept: the more websites linked to a page, the more important that page must be. It was a radical departure from the keyword stuffing and directory listings that dominated the nascent web. But from this academic curiosity, something extraordinary began to emerge. A silent revolution brewing. Their groundbreaking algorithm, PageRank, was the engine of Backrub. Unlike its competitors, it didn't just count keywords. It analyzed relationships, trust, and authority across the vast, expanding web. This mathematical elegance promised an unprecedented level of relevance. But building this system required immense resources, far beyond what two graduate students could muster. Early servers were cobbled together from spare parts. Their office? A dorm room, then a cramped garage. The ambition was gargantuan, but the infrastructure was perilously fragile. Could such a nascent idea survive in a world of giants? The late 90s internet was a chaotic, untamed frontier. Search engines like AltaVista, Excite, Lycos, and Yahoo ruled the digital landscape. Each offered a different gateway to information, often cluttered with banner ads, slow directories, and inconsistent results. They were behemoths, well-funded and established, with millions of users. For Backrub, or Google as it would soon be known, to even register a blip on their radar seemed impossible. The market was saturated. Innovation was rampant. But so was competition. Would their nascent technology be swallowed whole before it could even breathe? The moment that arguably prevented Google's immediate demise came with an unlikely hero. Andy Bechtolsheim, co-founder of Sun Microsystems, met Brin and Page in August 1998. Their presentation was brief, their vision grand. Bechtolsheim, seeing the potential, didn't wait. He wrote a check. But to whom? Google Incorporated didn't officially exist yet. Brin and Page were still struggling to even incorporate. The check, for a staggering $100,000, was made out to a company that was literally a figment of their future. This single act of faith, against all corporate protocol, bought them precious time. A lifeline, unexpected and immediate. With Bechtolsheim's check in hand, Brin and Page officially incorporated Google Incorporated in September 1998. Their first office was a garage in Menlo Park, owned by Susan Wojcicki, who would later become a key Google executive. It was a space teeming with makeshift servers, tangled wires, and boundless optimism. But funding was still a critical issue. The $100,000 was a start, but hardly enough to build a global search engine. They needed more, much more, to compete with the well-entrenched giants. The early days were a constant battle for survival, every dollar stretched to its absolute limit. A precarious existence. As Google slowly gained traction, its innovative approach did not go unnoticed. Competitors, while initially dismissive, began to see the threat. Especially Excite, then a major player in the search and portal space. Their leadership saw a glimpse of Google's superior technology, yet fundamentally misunderstood its value. They were focused on building content portals, sticky experiences, not just pure search. This strategic divergence would prove fatal for many. The internet was evolving, but not everyone was evolving with it. Some saw the future as directories, others, a raw, elegant algorithm. In 1999, just months after Google's incorporation, Excite CEO George Bell made an offer. A chance to buy Google for a mere $750,000. It was a significant sum for a fledgling startup in a garage, but Brin and Page had a higher valuation in mind. They counteroffered, asking for $1 million, plus 1% of Excite. Bell scoffed. He believed Google's technology was good, but not worth that much. He feared that improving search results would pull users away from Excite's advertising-rich portal pages. A profound miscalculation. A moment where the internet's destiny hung precariously. The rejection of Excite's offer was a monumental gamble. Most startups, facing fierce competition and financial strain, would have jumped at the chance to sell. But Brin and Page believed in their vision, in the purity of their search results, unburdened by advertising or portal distractions. Bell's fear that better search would reduce user time on other pages was exactly Google's strength. They wanted to get you to the right information, fast. Not to keep you on their site. This clash of philosophies defined the nascent internet's direction. To sell, or to fight for an ideal? A defining choice. Even with an unwavering vision, the technical challenges were immense. The web was growing exponentially. Indexing billions of pages, processing countless queries per second, and delivering results in milliseconds required a distributed infrastructure on an unprecedented scale. They needed more servers, more engineers, and sophisticated data centers. The garage was no longer sufficient. This wasn't just about writing algorithms, it was about building a global computing backbone from scratch. A task that could easily overwhelm even well-established companies. Could a small startup manage such a colossal undertaking? Then came the storm. The year 2000 saw the bursting of the dot-com bubble. Investor confidence plummeted. Startups, once flush with capital, suddenly found funding drying up. The market correction was brutal, wiping out countless internet companies overnight. This was a particularly perilous time for Google. Still relatively new, still heavily reliant on venture capital, they faced an economic climate that turned hostile almost instantly. The dream of organizing the world's information could have easily been crushed by the harsh reality of a failing market. Survival itself became the primary metric. The financial risks were real, acute. While Google had secured some early funding, the dot-com bust created a chilling atmosphere. Investors became wary, scrutinizing every business model for profitability. Many promising companies simply ran out of cash. Google's revenue model, initially non-existent as they prioritized user experience over advertising, made them look like another risky bet. The prospect of bankruptcy was not just theoretical, it was an ever-present specter, threatening to extinguish their vision before it could truly shine. The company walked a tightrope, with the abyss yawning below. In the midst of this turbulent period, Google desperately sought crucial institutional funding. They found interest from two Silicon Valley giants, Kleiner Perkins Caufield and Byers and Sequoia Capital. These firms had backed some of the most successful tech companies. Their investment wasn't just money, it was validation, expertise, and a network. But securing their support was no easy feat. Google's founders had to convince hardened investors that their pure search model, without immediate advertising, was a sustainable, revolutionary path. A bet on potential, not just present profits. The pitches to Kleiner Perkins and Sequoia were high-stakes affairs. Brin and Page had to articulate not just the technical superiority of PageRank, but the long-term, transformative power of truly unbiased search. They had to counteract the prevailing dot-com wisdom that demanded immediate revenue streams and portal lock-ins. It was a battle of ideologies, short-term gains versus long-term vision. Convincing these formidable investors was paramount. Their decision would not only determine Google's future, but potentially the very structure of the internet itself. The fate of a nascent empire, hanging in the balance. Against the backdrop of a collapsing market, Kleiner Perkins and Sequoia Capital made their move. In June 1999, they co-led a $25 million funding round for Google. This wasn't just an investment, it was a vote of confidence, a monumental gamble during one of the most volatile periods in tech history. This influx of capital provided the necessary fuel for Google to scale, to hire top talent, and to build the infrastructure required for its ambitious vision. It bought them the runway they desperately needed to survive the dot-com winter. A critical infusion against all odds. Armed with fresh capital and an unwavering belief in their product, Google continued to build. While many of its contemporaries faltered, went bankrupt, or were acquired for pennies on the dollar, Google quietly, relentlessly expanded. Its pure search experience, uncluttered by ads, began to win over users at an accelerating pace. The dot-com bubble may have burst, but the need for reliable information only grew. Google stood as an anomaly, a testament to the power of focus and a bold, contrarian strategy. They didn't just survive, they thrived in the chaos. The decision to prioritize user experience and search relevance over immediate advertising revenue, a decision that nearly cost them their existence, proved to be their ultimate triumph. This philosophical stance attracted a loyal user base, setting them apart from every competitor. They refined their PageRank algorithm, expanded their index, and relentlessly pursued speed and accuracy. The foundation laid during those precarious early years, under the constant threat of failure, forged the company's core values. A testament to perseverance against a relentless current. By the early 2000s, Google was no longer just a search engine, it was becoming an internet phenomenon. Its brand, once an obscure academic project, was now synonymous with finding information. In 2004, Google made its public debut on the stock market. The IPO was massive, valuing the company at over $23 billion. This was a far cry from the garage startup, the rejected acquisition offers, or the looming specter of bankruptcy. The moment that almost saw its demise was now a distant memory, replaced by a global presence that would soon permeate every aspect of digital life. From near collapse to colossal success. What if Excite had offered more? What if Bechtelsheim hadn't written that check to a non-existent company? What if the venture capitalists had sided with conventional wisdom during the dot-com bust? The internet ecosystem would be profoundly different. Search might still be fragmented, dominated by portals prioritizing advertising over relevance. Innovation might have been stifled, access to information less equitable. The choices made, the risks taken, the crises averted, all converged to shape not just one company's destiny, but the very fabric of the modern world. A fragile chain of events. The story of Google's near disappearance is a powerful reminder that even the most dominant forces began as fragile ideas, vulnerable to failure. It highlights the critical roles of bold decisions, unwavering vision, and sheer luck in the volatile world of technology. The company we interact with daily, the search engine that answers our every question, almost never was. Its survival was not predetermined but earned through a series of harrowing escapes, critical gambles, and an unyielding belief in a better way. The internet, forever changed by a crisis almost nobody remembers.